us to decode what will happen with markets in the second half of the year as Indian markets have completed H1 is Feroze Azeez, Joint CEO, Anand Rathi Wealth. Good morning, Feroze. Pleasure having you back with us on News 9. I want to understand from you, and first up, just look at some data. Sensex has soared as much as 6,000 points in the Jan to June period of this year, 2025. That Sensex returning almost 8% in H1 alone, despite the kind of volatility that we've seen. And just in the last week, Sensex and Nifty delivered as much as 2% or so. Now, the point is, Feroze, we are just 2,000 points or so away from lifetime highs on the Sensex. Well, considering yesterday's decline, maybe add another 500 points, 2,500 points in a time when volatility is also low between the 12 to 13 odd levels. How long before we see greater momentum in H2 and climb back on those lifetime highs that we saw in September?
Good morning, Kartik. Like you rightly pointed out, we've had a good first half year. Sensex is about 2.66% lower than its peak of September. So we've already gone through a time correction of almost a year, about 10, 11 months. September is when this happened last year. So I think 10, 11 months of time correction is a great time correction, especially given the fact that Nifty has given an earnings growth in that last financial year of about 8.7%. So to answer your pointed question, do I see markets going back to the peaks in the second half? The answer is a big yes. Point two, can it peak? Can it go 8-10% more than the peak? Maybe, with odds of 60-70%. But if you look at how, why would I say this is there are about 3-4 barometers on the derivative side we track. Then we come to the cash markets, dissect the liquidity, and then look at the fundamentals. So these are the three buckets in which we look at. Derivative barometers, cash market barometers, which is liquidity, and then the fundamentals. If you have to call it the fourth bucket, which is the macroeconomic environment, which is more long-termish. So keeping all this in mind, I'll probably go deeper in it. I think 3 out of these 4 boxes are a big tick mark. So I would say that inching above the peak is also quite likely in the second half of this calendar year, and definitely so in the financial year.
All right. Well, definitely in the financial year, probably in the second half of the calendar year. Well, let's talk about some of those macroeconomic parameters that you were talking about, and also some domestic as well as other international trends that we are likely to see, Feroze. First up is the domestic earnings for Q1 are likely to come in from next week. Next up is on the domestic side is also a good monsoon and hence a good inflation print expected. These are 2 factors domestically which may move the needle on the broad markets one way or another. What are you expecting from these 2 points before I move to the international points?
Yes, Kartik, like you rightly said, this first quarter results, I'm expecting a growth of about 9 to 12% for Nifty companies, quarter year on year. For the same quarter, not sequentially, of course. We have closed the Nifty earnings at 1,096 for the last year. I'm repeating for the benefit of your viewers because most people track only the growth of it and not the absolute number of 1,096 was the earnings closure for last year. I personally think closing above 1,250 is very, very likely for this financial year. So if that were to happen, markets get a lot of support from the Nifty standpoint. Of course, if you look at last year, the small cap index grew by about 7.1%, but the mid cap, which was a surprise, Nifty mid cap 150, grew its earnings by about 16.5%, which was hardly spoken about. Of course, Nifty mid cap 150, the reason why I'm referring to that is because that's the tier 1 benchmark for domestic institutions, especially mutual funds, as per SEBI. So even if you're not a mutual fund investor, when the money is coming into mutual funds and that's what is keeping the markets afloat, then you have to track the indices which the fund managers track. Rather than the ones which you have invested in.
That's right. Okay, and let's move on to perhaps the second part of my question, which are the international factors which are now likely to move the needle on the markets. And the first one, of course, seems to be, Feroze, the tariff deadline of July 9th, which we are just a few days away from. And while we are reading every day and we are reporting every day that we are very close to finally going ahead and signing that trade deal with the U.S., nothing concrete really has come out just as yet, though I understand the markets have priced that in. But any adverse impact of the July deadline, July 9th deadline, is something that could potentially move the markets. In addition to that, we'll also have to wait and see what the U.S. Fed does as part of its FOMC scheduled on the 29th and 30th of July. Add to that, another global event happens to be oil prices, which seem stable for now. But the point really is that can oil slip further if stability in the Gulf continues? So, Feroze, these three international events, starting first with the deadline on tariffs, and what if, just what if, India is not able to stitch up a deal in time? How are markets likely to react?
Kartik, like you read out all the very, very important global events which are coming up, which are slated to happen very shortly. I think those are very, very relevant from a trader's standpoint. From an investor standpoint, when it comes to the global market, I am looking at two, three things which are very critical, lesser spoken about in Indian media for sure. The credit default swaps of the US Fed, US paper, government paper,
Right.
had reached about 90. Now they're back to 42, 43. Ideally, that was the highest ever in the last 15, 20 years, and Indian media didn't speak about it at all, and I was surprised. Because the biggest risk India or any global market runs is US's default, not a technical default, but a default because of printing of money.
Right.
So that's one thing which was very, very scary till a little while back. Second, very important thing from an investor standpoint, I'll come to the trader aspects which you spoke of,
Sure.
is how will Fed reduce its balance sheet? The Fed is definitely going to reduce its balance sheet, but how will it reduce? If you can't do QE was expanding their balance sheets. Now inflations are so high that they can't do QE. QT is what is going to be the future. If QT is going to be the future, Fed holds about 6.5 year papers in their portfolio. Even if they don't sell those bonds, but they hold it to maturity, in 6 years, their balance sheet size could come down to half. That's what a 6 year average duration on their balance sheet on the debt side means. So, point is, how will Fed reduce its balance sheet will dictate the global news, not news, basically global flow for the Indian markets over 2-3 year periods. Now, coming to the more important, of course, here and now. I'm not too worried about the deal, the deadline, because all those will be buying opportunities for me. Because
Okay.
there is a who blinks first kind of approach when you're negotiating a trade deal, and that both of us, because our exports to US are about 2.5%
Right.
of our total GDP. So, a point I'm trying to make is it's not going to be a make or break. It's going to be a sentimental dampener. There is going to be some degree of push and pull. But that is not going to dampen the market more than a month or two. And those
Okay.
are all, anything which markets bounce back sharply are buying opportunities. And that's what I think it will provide.
All right, Feroze, I want to go back to the point that you were making on the Fed's balance sheet and the technical credit default possibility, probability, which perhaps is now behind us. But the point is that Donald Trump is also pushing for the one big, beautiful bill and wants to sign that by the 4th of July. Now, that in itself is likely to increase the U.S. debt, external debt, by as much as $3 trillion. Further, this time, then increasing the charges of, or the possibility, therefore, of the U.S. default growing even more exponentially.
Yes, so I personally think the reason why I'm not worried about a complete default is because the debt ceiling is removed in January this year.
Right.
So I personally think, like you rightly said, they have a $36 trillion debt. They were supposed to add 1.3, $1.4 trillion of debt this year. But of course, this trade deal, the bill which is expected to do on 4th of July,
Yeah.
can definitely add to the debt. But I think the biggest concern is going to be the debt rate and the refinancing,
Okay.
because the Fed has a very weird yield curve. A very weird yield curve. Why do I say that? The 1 year paper is at 4.1, the 2 year paper is at 3.7, the 3 year paper is at 3.8, the 10 year paper of Fed is US government is at 4.3, 30 year paper is 4.8. So this implies that long-term people are bearish on the debt market. So I think how will long-term borrowing and the borrowing cost impact the US government is for us to see. But I think the larger problem is the $36 trillion debt and the refinancing which it will need in a staggered fashion over the next 2-3 years.
All right, and let's move away from US briefly in the interest of time and talk about oil prices. And oil prices have stabilized. In fact, they had hit almost a 1.5 year low or so yesterday, and they seem to be stable for now. Now, given the fact that perhaps the stability in the Gulf region is going to stay at least for some time, what is the kind of impact that we should expect on Indian markets of stable oil prices, at least for now?
Yes, well, Kartik, I think stable oil prices are very important because there is some degree of liquidity infusion because of the inflation coming down. We were at, after COVID, we were as high as 9.2, of course. That was because of a lower pay, because of whatever we went through. Then it was 6.7, 6.5, and so on and so forth. Now we are at 4.4 inflation. That's why for after about 2 years, 2.5 years, the RBI has been able to cut repo rate three times this calendar year. So I personally think if that has to continue, and the CRR windfall liquidity is also something which was very crucial. So I personally think crude oil prices being muted and stable is one of the key ingredients for domestic liquidity, and that's what has been driving the Indian capital markets and their buoyancy. Because domestic institutions have put in 14.5 lakh crores in the last 4 quarter years, where FIIs in the same period have done a net purchase of almost zero. So I think if that has to sustain, I think crude oil prices being stable is a very important raw material.
All right, Feroze. Well, I would want to thank you on that, but I can't let you go on the 1st of July without really asking you that for investors, long-term investors entering H2 today, July the 1st, what should be their investment strategy? Buy on dips, perhaps go for focus sectors, pick up thematic stocks. What should be the strategy for investors entering July 1st?
I personally think whenever the largest sector is the least value, you need not pick up large just to make your life interesting. You don't have to go peripheral sectors. If the
Okay.
largest sector, which is the banking sector, which has 31% weightage in Nifty, is one of the lowest in terms of their relative valuation to their past. It's still one sigma lower than the mean valuation,
Okay.
be it price to earning or price to book. So
Okay.
any innovation you're doing is basically to quench your thirst of innovation rather than the strategy itself. That's point one.
Okay.
Point two, as a theme, one thing which stands out is Indian capital markets are going to get a lot of push. So, be it savings, lending, infrastructures, financial services. So, Nifty capital markets, which has zero weightage in Nifty, capital market stock have zero weightage in Nifty. Next 4 5 years, you will have a reasonable weight of capital market infrastructure stocks, be it the exchanges, be it the depositories, be it wealth management, asset management companies. So that stands out as a theme for 3 4 years. To my mind, India can't be a great global capital market without any capital market stock represented in the form of Nifty. And if they come into Nifty, the free floats get gobbled up by index funds, and that gives you a little PE re-rating in spite of higher valuation.